Picture a man named Roger in the fall of 2001. He has worked at the same energy company for 19 years. He knows the people in the cafeteria by name, and when the company matched his retirement savings with shares of its own stock, he loaded up. By the end of the year, 62% of his entire 401k sat in that single ticker. Then, in a matter of weeks, Enron filed for bankruptcy. The stock went to zero, and Roger lost his active paycheck and his decades of accumulated retirement savings on the exact same afternoon. Roger wasn't a gambler chasing a reckless payout. He drove past the headquarters every morning and could see the lights on at night. He based his financial decisions on a feeling of safety, assuming that physical proximity and corporate loyalty equated to stability. Trusting an employer with your current livelihood and your future savings creates a massive vulnerability disguised as loyalty. It is comforting to write Enron off as a rare criminal fraud that has no relevance to a normal, well-run workplace. So let's look at General Electric, a company nobody calls a scandal. Around 2018, GE was the ultimate trusted blue chip, literally inside the Dow Jones Industrial Average for over a century. Yet its share price quietly collapsed roughly 60% from late 2016 to mid-2018, all while the broader S&P 500 actually rose by 25%. Your employer already controls your income, your health insurance, and your job security. Stacking your retirement into their shares creates an overlapping liability. When times go bad, the two losses arrive together at the exact same moment. Catastrophic financial ruin does not require a criminal villain or an elaborate fraud. It only requires one ordinary company to have one ordinary bad decade. Compare two 35-year-old coworkers who each saved $200,000. Coworker A leaves half concentrated in her employer's stock. Coworker B uses a total market index fund. If the stock drops 60%, A's net worth plummets, while B's diversified portfolio remains intact. In traditional investing, assuming a higher degree of risk is supposed to compensate you with a higher potential return. Company stock concentration breaks that rule. The market forces you to assume double the danger, but it pays you absolutely zero premium in exchange for taking it. The reason smart people walk into this comes down to familiarity bias. As humans, we regularly confuse knowing a company's products and trusting our coworkers with actual protection against market volatility. Financial autopilot systems exploit this trust. Employers frequently pay out matching contributions entirely in shares or offer discounted employee stock purchase plans. The risk slowly hoards itself in the background, year after year, without you ever having to actively click a buy button. For old-fashioned pension plans, lawmakers recognize this exact danger. Federal law under ERISA explicitly forbids those traditional pensions from holding more than 10% of their assets in company stock. But that legal safety cap does not apply to modern 401ks. Over a third of 401k plans that offer employer shares have absolutely zero limits on how much concentration a worker can hold. Workers rarely ever wake up and actively decide to wager their life savings on a single corporate outcome. The financial system slowly makes the dangerous bet for them while they aren't looking. This line graph from 2005 to 2022 shows participants holding company stock collapsing from 29 to 8%, and the extreme risk group, those holding over 20% in a single ticker, shrinks down to a mere 3%. The professionals running these corporate plans analyzed the math behind ordinary failures like GE and explicitly began pulling company stock off the menu. Passively ignoring your portfolio and holding on to those shares means you are actively betting against the institutional smart money that already ran the math and walked away. The immediate fix is straightforward. Log into your account and ensure your employer's stock makes up no more than 10% of your total portfolio. If your concentration sits above that 10% threshold, formulate a deliberate plan. Wait for market upswings, sell off slices of the stock, and systematically swap those funds into low-cost, broad market index funds. If you already hold heavily appreciated company shares, you can utilize a specific tax provision called Net Unrealized Appreciation, or NUA. Normally, 401k withdrawals are hit with severe ordinary income taxes. NUA allows you to withdraw the stock as a lump sum, pay ordinary income tax only on the original purchase price, and apply the much lower long-term capital gains rate to all the growth. This is a highly regulated emergency exit designed to soften the blow for workers already trapped in massive positions. It is absolutely not an excuse to begin stockpiling new shares. True financial success requires severing the link between your current paycheck and your future nest egg. Spread the risk, diversify your holdings, and ensure no single company ever has the power to erase your future.